Are you aware you can achieve great financial strength through saving money, including the capacity to support future objectives and deal with unforeseen situations? It might be difficult to choose where to save your money when there are so many possibilities available. The best place to save money depends on some variables. However, in most cases, these are interest earning accounts with little to no chance of financial loss. Not the most profitable locations, but the safest ones to keep your savings. Welcome to yet another great video regarding money, wealth, and finance. Here, we highlight every necessary information, tip, and advice regarding finance, trade, and investments that you need to know. Today, we're introducing you to 5 reliable investment vehicles where you may put your money to work through savings and making a good interest in return. If this is your first time on our channel, kindly hit the like and share buttons and subscribe for more tips on money, wealth, and finance. Let's get started. At the moment, inflation outpaces any yield you may expect to get at a bank or credit union. You may be risk adverse if you want to keep your money's purchasing power, which means investing in equities. Here are 5 ways you can safely save money and earn a little interest if your objective is to increase your savings with minimal damage. Meanwhile, before opening a savings account, consider the following questions. For what am I saving? When would I require this cash? Consider the scenario where you are increasing your emergency reserve and may require your funds immediately. You should maintain your money in an account that is simply to access and where withdrawals won't result in fees. On the other hand, if you're saving for a down payment on a house and know you won't be buying one anytime soon, you might want to think about an account with less liquidity and a higher interest rate. Additionally, you can decide to establish various savings accounts for various objectives. You're free to create your own savings plan. You can create a plan to save and optimize your interest income using the following strategies. Number 1. High-yield savings account. If you want to ensure that your savings are earning interest while still being reasonably accessible, a high-yield savings account is an excellent option. Most savings accounts, if not all of them, have a monthly withdrawal and transaction cap of 6. However, you often receive a larger interest rate than you can with checking accounts in exchange for less liquidity. A high-interest savings account might have an APY of 3.75% compared to a standard savings account annual percentage yield APY of 0.19%, for instance. The disparities in salaries can be substantial. In this case, $1,000 could earn $1.9 if deposited into a standard account with a 0.19% APY, but $1,000 deposited into a 3.75% HISA would earn $3. How do high-yield savings accounts work? Similar to a standard savings account, a high-yield savings account pays out interest, but typically at a greater rate. A bigger starting deposit is needed at some banks and credit unions to qualify for a higher interest rate. The lower minimum deposit amount is typically required for the top high-yield savings accounts. The Federal Deposit Insurance Corporation, FDIC, reports that as of April 17, 2023, the national average savings account rate is 0.39%. meaning that these accounts have the potential to pay 10 times or more than that rate. Opening a high-yield savings. A high-yield savings account are offered by numerous banks and credit unions. When applying for an account, you must include identification and, if necessary, submit an opening deposit. Number 2. High-yield checking account. If you want instantaneous, unrestricted access to your money while collecting interest, a high-yield checking account can be a good option for your savings. Checking accounts, as opposed to savings accounts, typically include a debit card or check writing capabilities. The number of transactions you conduct with a checking account throughout a statement cycle is not limited. These accounts can be helpful if you're saving for immediate needs, such as a trip or a new appliance. They enable you to easily spend whenever you need to and earn interest on your balance. For instance, they enable you to use your debit card to swiftly purchase items during sales. What exactly is a high-yield checking account? Although interest is earned, high-yield checking accounts function similarly to conventional checking accounts. You'll typically need to fulfill monthly conditions, including making direct deposits of a particular amount to earn the interest rate. According to data from the FDIC, the best high-yield checking accounts offer rates that are significantly greater than the 0.06% national average for interest-bearing checking accounts. Some accounts need a minimal opening deposit, while others don't. How can a high-yield checking account be opened? You may fill out a straightforward account application, present identification, and make an opening deposit, if necessary, once you found a bank or credit union offering the rate and opening deposit criteria that meets your needs. Number 3. Series I bonds. A combination of fixed and variable returns is provided by Series I bonds to help preserve the purchasing power of your funds. Investors receive 2 rates. one set for the duration of the bond and the other variable, which changes every 6 months to reflect inflation. All urban consumers' movements in the Consumer Price Index serve as the basis for the variable rate. What are Series I savings bonds? Series I bonds are backed by the American government and serve as an inflation hedge for your funds. For 30 years or until you redeem them, whichever comes first, I bonds earn interest. The monthly interest is accumulated and compounded every 2 years. I bonds can be purchased for as low as $25 with a $10,000 annual cap per person. Series I bonds have no secondary market, thus you cannot resell them. Despite having a 30-year final maturity, Series I bonds can be redeemed after 1 year. You forfeit 3 months' worth of interest if you redeem the bond after the first year or before the end of the 5 years. How to purchase Series I savings bonds? With your IRS tax return, you can buy paper Series I bonds or electronic Series I bonds through Treasury Direct. Number 4. Certificate of Deposit, CD. Putting your money in a Certificate of Deposit or CD is another strategy to increase the return you receive on your savings. You can deposit and withdraw funds from a conventional savings account whenever you need to, up to the account's maximum. However, with a CD, you make a lump sum commitment for a certain period, referred to as a term, during which you are unable to make deposits or withdrawals from the account. Typically, CD lengths range from 6 months to 5 years. When the term starts, the CD interest rate is fixed and it doesn't change until the term is through. This makes investing in a CD a reliable option to generate income on your savings, while there are also drawbacks to consider. On the plus side, financial institutions like U.S. banks are providing CDs with APIs as high as 4.95%. The drawback is that to receive the best rate, you must deposit a minimum amount for a specific amount of time, usually a year or more. To begin with, you will be shackled to the lower rate for the whole term of the CD if market rates increase after the period of the CD starts. This might cost you hundreds or even thousands of dollars in interest, depending on how high the rates rise. On the other hand, if interest rates decrease after you open the CD, you will continue to receive the higher interest rate for the duration of the account. Longer-term CDs will often have higher interest rates. Following the CD's expiration, you will have the option to either withdraw the funds or roll them over into a new CD. The former indicates that you can utilize the funds to cover a big expense, like a down payment on a home or automobile, an international trip, or a medical bill. When you roll over your money into a new CD, interest will still accrue, but the term will begin over, and you won't have to access your money until the term is over. If you have the resources, think about creating a CD ladder, which is what happens when you open multiple CDs with various maturity dates to stagger your access to your money. You can benefit from the above-average returns of this sort of account by using a CD ladder while still having access to a portion of the funds in case of emergencies. Number 5. Treasury bills. Deposits in banks and credit unions are typically insured by the Federal Deposit Insurance Corporation at banks and the National Credit Union Administration, NCUA, at credit unions for up to $250,000 per depositor per account. But if you need to save more than that, Treasury bills, also known as T-bills, are a safe alternative. How do Treasury bills work? T-bills are short-term financial securities with maturities ranging from a few days to 52 weeks that are issued by the U.S. government. Although the returns may be lower than that of a conventional high-yield savings account, they are a secure investment since they are supported by the full confidence and credit of the United States government. You trade security for a low interest rate when you use T-bills. You may be able to park cash temporarily and earn interest by using T-bills. T-bills have two options: holding them till maturity or selling them earlier. There is a sizable secondary market which makes T-bills quite liquid, and you may access your money if you need to. How can Treasury bills be purchased? Treasury Direct and secondary markets, such as brokers, are both options for purchasing Treasury bills. In conclusion, the interest rate you could receive on your cash were extremely low over the past 15 years or more. Many savers are still unaware that they could be earning more on their money even though the Federal Reserve has changed that with a recent series of interest rate hikes intended to combat high inflation. Despite an economy with very compelling yields, very few people are earning competitive returns on their savings. A savings account that fits your comfort level and financial objectives the best is the one you should use. Before establishing a savings plan, spend some time investigating accounts at several banks and credit unions and comparing interest rates and terms. Remember, if it will help you better arrange your finances, you can open multiple savings accounts. Please let us know in the comments section if you are aware of any further ways that people might maximize their financial resources. And don't forget to give us a quick description of it. If you enjoyed this video and want to see more videos on money, wealth, and finance, as well as tips on investments, Kindly like this video and subscribe to our channel. Don't forget to enable the notification bell so you'll be notified whenever we upload new videos. Thanks for watching. See you in the next video.